So the truth is, the pre-approval process can either set you up for success or sabotage your entire home buying journey. And if your lender misses one step, or if they don't ask the right questions, or if you're giving the pre-approval letter that's not actually solid, it could be the reason that you lose the home that you've been working so hard for. So in this video, I'm gonna walk you through the entire pre-approval process, everything from start to finish, what should happen, what red flags to watch out, and the questions that your lender should be asking but probably isn't. Because if you're going to compete in today's market, then you need more than a letter, you need a solid strategy. Now let's get into it. So getting pre-approved isn't something you should do the moment that you're ready to tour homes. It should be a strategic process that starts early. So here's the overall timeline. So about 6 months out, you want to talk to a lender, have a conversation with them. And at this point, you're not trying to do a full loan application. What you're trying to do is just talk with them and identify any potential issues that you need to work on. Then about 3 months out, that's when you actually want to get a hard pre-approval. You want to have your lender check your credit, send in all your documents, go over your max pre-approval amount. Because here's the thing, what I see a lot of buyers making is they wait till the very last minute to get a pre-approval, and then they find out if there is an issue with their credit, they don't have enough down payment. It doesn't give them enough time to fix the issue. And for example, I had a client that wanted to buy a house in October. They came to me about 6 months before in the springtime around April. And we talked through a couple of things. We identified that their credit needed to increase just a couple of points. They were saving up for the down payment. So they took the next 3 months to really work on that. And by the time end of summer came, when they were ready to get a full pre-approval, they had everything in place. They are able to get pre-approved, and they are able to buy a house in the fall where they target wanted to be around October. Now let's go over exactly what the banks are looking at when they're pre-approving you. Okay, so here are the top 3 factors that the lenders look at when they're pre-approving you. So number 1 is going to be your credit score. Now, credit score directly impacts your interest rate, so the higher your credit score, the better interest rate you're going to get, and vice versa. There is a minimum credit score, and we will go into that a little bit later on down the road when we go over the different loan types. Number 2 is going to be how much income and how much debt you have. Now, this directly impacts how much buying power you have or how much you get approved for. Because the higher the income you have and less debt, the higher your buying power will be. And this is the main difference between someone getting approved for $100,000 and someone getting approved for $1 million. Then at the ending, you have your cash and how much savings you have. This is going to directly impact your down payment, closing costs, and also banks like to see that you have reserves left over, that they're not wiping you out. And a big issue that I see a lot of buyers making is they just assume that because they have a great credit score, they're automatically going to get approved, and that's not the truth. You have to have almost all 3 factors. They have to be in balance for you to get pre-approved. And here's a tip. If you want to see in the price range of how much you'll get pre-approved, is take your yearly household income before taxes, multiply it by 3 if you have a lot of debt, multiply it by 4 if you don't, and that will give you a rough idea of how much you'll get approved for. So let's say you make about $50,000 a year. If you have a lot of debt, you'll probably get a pre-approval for around $150. If you don't have much debt, it's probably going to be around $200. So if that gives you an idea of where you'll fall. Now, before you go into the next step that can make or break your pre-approval process, if you're planning to buy a house this year, make sure you hit that subscribe button so you get notified every time I put a video out. So before you start filling out any loan application, start gathering your documents now so that by the time you talk to the lender, it will help streamline the process, avoid any delays, and also give you the most accurate pre-approval letter because they're basing it off of your financial documents. So here's a list that you need. If you're a W-2 employee, they're going to ask you to provide all of your W-2s for the last 2 years from all of your jobs that you worked at. They're going to also ask you for your last 2 most recent pay stubs. And if you're self-employed, you're 1099, you own a business, they're going to need to look at your last 2 years of filed tax returns and base your income off of that. Now, they're also going to ask you for your last 2 months of bank statements to make sure there's not any like large cash deposits on there. And also write down everywhere that you've worked for the last 2 years, because they're going to ask you for your last 2 years of work history. They're going to ask you for your approximate start and end date. And it's important that you have that in writing up front so that avoids any inaccuracies later on down the road. And a common mistake is a lot of times when people are filling out loan applications, they're going based off of their memory and not actual on solid data, which could cause a discrepancy in the loan process. By the time you get to the underwriter phase, things start coming out and you could cause a denial. Also, for example, I have a client that she works, we call it variable hours. 1 week she works 32 hours, 1 week she works 40 hours, 1 week she works 36. And what we had to do is we had to look at we had to take an average of her year-to-date hours that she worked, and that's how the underwriter is going to base the income. So if we just went off of she worked 40 hours a week, it would have caused a problem with her income, and later on down could cause a loan denial. So, but because we looked at all of her financial documents and had them up front, we were able to approve her for a solid amount, and she got the loan. So here's what overall the pre-approval process looks like. So number one, it's going to start with a phone call. And in this phone call, it's really to understand your situation, what needs your house, what needs you have, and also like what route we're going to take. Then number two, we're going to have you fill out a questionnaire. It gets your basic info. At that time, this is when you're going to submit your documents like your W-2s, your pay stubs, tax returns that we talked about earlier. Then it's crucial to understand at this time, we're not actually doing a hard pull on your credit. We're just doing a soft pull. And the reason is a hard pull, number one, it brings down your credit score. Number two, it only lasts that credit report for a certain period of time. And if you are not at the place where you're ready to start looking at houses, or if you're not fully pre-approved, then a hard pull doesn't make sense at that time. Then if once everything is filled out, you upload your documents, the next day we will have a loan consult together. In a loan consult, we'll go over several different things. Number one, it's going to be your max pre-approval amount. And then we'll also talk through scenarios on your monthly payment to make sure that the monthly payment where you want to be at lines up with your pre-approval. And if we need to adjust that amount down, that's at that time, that's when we'll do it. Then we'll also go over which loan type is going to be best for you. And also we're going to go over how much down payment you have, estimated closing costs, cash to close, and strategies for that. Then I'll send you an actual pre-approval letter, and that's when you can go out looking and shopping for homes. Now, a common mistake that I see a lot of lenders making is they don't do the initial phone call up front, so they don't really identify or get to know your actual scenario, because people's scenarios are very different, very unique, and you want to make sure you have a plan that's tailored to your specific situation. And overall, this process from start to finish takes anywhere from about 1 to 2 days. It really depends on you, how fast you can get your documents uploaded and get that questionnaire done. Now let's go over FHA loans and talk about all you need to know about that. So FHA loans are one of the most lenient types of loan programs that's out there, which makes them one of the most common types of loans that's used. And it's backed by the Federal Housing Administration, so it's a government loan. And to qualify, you need the following. So number one, minimum credit score, it's really a 620. Now you will see other places advertise that, yes, you can go down to a lower credit score, a lot of times in the 500s, but what they don't explain to you is, number one, you're gonna need a higher down payment, typically at least 10%. Number two, you're gonna get killed on the rate and the fees. So really that next benchmark is gonna be a 620. Because with the 620, you can put down minimum down payment, which is 3.5% of the purchase price that you're buying. Also, you need at least a 2-year work history. Now, it doesn't have to be in the same job or even the same line of field, just as long as you have had a job in the last 2 years. And also, you can only use this loan to buy your primary residence, so to buy the home that you're living in. Now, what's nice about this type of loan is you can buy a multifamily, and as long as you live in one unit, you can rent out the rest, and that will suffice for an FHA loan. Where this loan, you cannot use it is if you're buying just a straight like single family home, townhome, condo, where you're not living in it at all, you're buying it straight as an investment property or a second home. That will not work for FHA. You have to live in the property for at least 1 year. Also, the debt to income ratio is 56%, which means that 56% of your monthly income can go towards your monthly debt. And a big common misconception I see a lot of people think about FHA loans is that it's only for first-time home buyers, and that is not true. You can be a second-time homeowner, third-time homeowner, and use the FHA loan. Where it gets tricky and where I think this misconception has came into play, if you have 2 homes with 2 FHA loans on them, a lot of times they don't allow the second home to have, both homes to have FHA loans, but there's very strict requirements. So if that is your situation, reach out to your loan officer and talk to them, because it can be done, but there's very specific guidelines on that. But yes, anyone can use an FHA loan. And here are some of the pros and cons. So the pro of this type of loan, you can buy a house with a lower credit score with a higher debt threshold limit. But some of the cons are, number one, it's more strict on the condition of the home that you're buying. Pretty much needs to be in move-in ready condition. If you are wanting to buy a fixer-upper, this is not going to be the type of loan that you can use on this, because what's going to happen is the appraiser is going to come out, take a look at the home, do their own inspection based on FHA guidelines, and if there's any safety issues, if there's any like leaking roof, broken windows, things like that, they are going to condition, and in order to close on that loan, the seller is going to have to fix those issues before you can close on the home. And also another con is going to be the mortgage insurance. And the mortgage insurance on an FHA loan is dealt with two ways. So number one, you pay an upfront fee that's financed into the loan. It's a percentage of the overall loan amount. And two, you also pay for it on a monthly base. And the mortgage insurance, unlike a conventional loan, it stays for the life of the loan, especially if you're putting the minimum down payment, which is 3.5%, never goes away, it never drops off. So this loan is best used for short term. And a lot of my clients, we use the FHA loan, they have a lower credit score, they can't qualify for a conventional. We use the FHA loan, get them into the house. Once they have worked on their credit, and a lot of times having a mortgage that you're paying on time will jump up your credit score just by having that. Later on down the road, we refinance into a conventional loan and take off the mortgage insurance, which saves them on their monthly payment. So it's really not for using it as a long-term plan, it's really a short-term solution. Now let's go over everything you need to know about conventional loans and how to qualify for them. So conventional loans are backed by private lenders that are then sold to Fannie Mae and Freddie Mac. And this is the most flexible loan product out there for those with a higher credit score. Also, this is the best for long-term savings. So if you're going to have a mortgage on a home for a long time, you want to make sure that that loan type is going to be a conventional loan. And to qualify, minimum credit score is going to be a 680. And it's really a 680 score plus for this loan type to make sense. And minimum down payment is going to depend on what you're trying to get done. So if you're trying to buy a primary residence and you're a first-time home buyer, minimum down payment is 3%. If this was not the first time, you're not a first-time home buyer, minimum down payment is going to be 5%. Now, if you were to buy your second home, meaning that the second home is not going to be used for long-term rentals, then minimum down payment is anywhere from 10 to 15%. And if you were to buy a straight investment property, minimum down payment is 20%. Now, same thing with FHA. You need a 2-year work history to qualify. Doesn't have to be in the same job, doesn't have to be in the same line of field, just as long as you have had a job for the last 2 years, that will satisfy this. Now, the difference though with this type of loan is going to be best used for those that are straight out of college entering the workforce, because as long as you are working in your profession that is the same line of field that you got your diploma or degree in, you do not have to have a 2-year work history. You can actually use your time in college as your 2-year work history to satisfy this, which is specific to a conventional loan. Now, debt to income ratio is 50% of your monthly income. It's capped at 50% of the monthly income can go towards your monthly debt. Now, a common misconception that I see is a lot of people assume that with conventional loans, you automatically need 20%. That's not true. I think where this came from is conventional loans were really the original type of mortgage. So think back in the 50s when your grandparents or your parents went to buy a house, they went and got a conventional loan. Homes back then were like $40,000. They put 20% down. And as times changed, as homes became less affordable, as affordability became an issue, that's when the government came out with programs like FHA, VA, USDA that required lenient loan products for the down payment, and then conventional followed with a lenient, less down payment required. Now, here are some of the pros when it comes to conventional loans. Number one, it's not as strict as other loan types when it comes to the condition of the home. So you could essentially buy a fixer-upper, use a conventional loan. Now, it cannot be demolished or it has to pass certain safety guidelines, but overall, this is less strict. This is also why sellers tend to like taking a buyer that is using a conventional loan versus a government loan. Also, this loan allows non-permanent residents to buy a house. FHA no longer allows it. So conventional, as long as you have your visas in place and permits, then they will allow you to buy as a non-permanent resident. Now, one of the biggest pros over FHA loans is going to be the mortgage insurance, because number one, typically if you have a higher credit score, the mortgage insurance on a monthly base, if you're putting less than 20% down, is going to be cheaper than an FHA loan. Also, it drops off automatically once you've closed on the home and you have at least 78% of equity in the home. It automatically drops off, which is one of the biggest differences between FHA and conventional. Also, one of the cons is it has a less debt to income ratio threshold than the other loan types. So if you have a high debt to income ratio that above 50%, then conventional is not going to be the way to go. So overall, you want to see if you can qualify first with a conventional loan at the very least, then you have FHA as a backup. You can always refinance into a conventional loan later on down the road. Now let's go over VA loans. So VA loans are for either active military, surviving spouses, or veterans, and it's actually the Veteran Affairs is insuring the loans. They're not directly lending to the public. They're not actually giving them money. They're only insuring the loan. So you have to use either a mortgage broker, lender, or bank that is VA approved in order to get a VA home loan. Now the benefits are going to be, there is 0% for the down payment, no down payment required. There's also no mortgage insurance that's required, and you're also going to get one of the best interest rates on the market. VA loans have a lower interest rate than FHA, USDA, and conventional, so you're going to get the best monthly payment using your VA home loan benefits. Now, to qualify, you have to download your certificate of eligibility. You can get this on the VA portal. Also, your lender can help download this as well, and the certificate of eligibility will show exactly if you are eligible to use your VA home loan benefits or not. Also, you can only use this to buy your primary residence. Now, a big thing with VA home loans is they're very strict on the cosigner. So if you need a cosigner on the loan, it can only be either your spouse you're legally married to or another veteran that has their VA home loan benefits. It can't be a parent, it can't be a son or daughter. It has to either be, like I said, either a spouse or another veteran that has access to their VA home loan benefits. And they'll also allow you can have several homes with a VA home loan on it at the same time. The only difference comes every time you use your VA home loan benefits, it uses up your eligibility. So the next time, if you don't refinance out of your VA home loan, the next time you go to buy a house, you might have to end up bringing your own down payment. Now, here's a strategy, and here's how to really use your VA home loan benefits to your full advantage. This is actually one of my clients, how he has built up a full rental portfolio using his VA home loan. So what he does is he goes and buys a house, he lives in it as his primary residence, he puts down 0% and uses his VA home loan. Then years down the road, he refinances into a conventional loan, and at that time, he puts a tenant into the home, and he goes and buys another home using his VA home loan, 0% down, and repeats the process year after year. That's how he's built up a cash flow of rental portfolios. Now let's go over USDA loans and the difference with that. So USDA loans is a government loan that can be used to buy a home in a rural area, and what they consider as USDA, you have to look at the map online, and that will show you exactly what the approved areas are. This can only be used to buy your primary residence, and the benefits of this loan is there is no down payment required, and also there is a low mortgage insurance as compared to FHA and conventional loans. Now, to qualify, you need several things. Number one, minimum credit score is going to be a 640. Number two, you must meet certain income restrictions and guidelines. You can look on your county's website and USDA as well. And also, again, the home must be an approved USDA area. And the home itself must be in good condition, must be in move-in ready condition, and the debt to income ratio is going to be capped at 45% of your monthly income can go towards your monthly debt. Now let's look into loans that if you don't fit the conventional box, how you can get that done. So the next type of loan product that we have, it's called NonQM loans, or non-qualified mortgage loans, and those that are best for those that don't fit into the traditional guidelines of a regular type of mortgage. And these are going to be most popular for those that are self-employed, business owners, investors, and you can use nice about these loans is you can use alternative documents that you can't use with a traditional loan. Like you could use your bank statements. You can do what's called the bank statement loans, where they look at your last 12 to 24 months of bank statements, take the income off of the actual bank statements in lieu of providing your actual tax returns. Also, you can do what's called a 1099 loan, where they just take an average of your last 2 years of what's on the actual 1099, again, in lieu of your tax returns. Then you can do what's called a DSCR loan, where you can buy an investment property 20% down. They don't ask you, they don't look at your debt to income ratio, they don't look at any of your income documents. It's only how much income is the property producing with the rent cash flow. So those are type of examples of different types of loan products that you can use for non-QM that will allow you with alternate documents. Now, the requirements for these types of loan, a lot of times they require a higher down payment than a traditional type of loan. If you're buying a primary residence, anywhere from 10 to 15%. If you're buying a straight investment property, it's going to be 20%. You do need a little bit higher credit score to utilize these types of loan products. Normally at least like a 660 to 680 is the minimum down payment, or the minimum credit score that's required. And these loans do have a little bit higher interest rate than a normal conventional FHA loan. Now let's go over the entire breakdown of which loan type is going to be best for you and your situation. Now that we've gone through each different type of loan product, here's a basic overview of which one works best with each scenario. So FHA is going to be best for a lower credit score with a higher debt to income ratio. Conventional is going to be best for those with a higher credit score. VA is those that are in the military. USDA is used for homes that are in rural areas. And non-QM loans are those that don't fit into the traditional mortgage box, and also need loans that have alternative documents. You know, it's important during the pre-approval process is to really understand and compare the monthly payments, also compare your cash to close with using different types of loans to see which one's going to be best in your situation. And make sure that you run through an overall strategy with your loan officer, with your lender that you choose, because you want to make sure that you're running through all the different scenarios so that you really understand and know your options up front. So pre-approval is generally good for at least 60 to 90 days as long as nothing has changed. Now, the only time this doesn't come into play, 60 to 90 days, is if something has changed, as in your credit score has dropped, you changed jobs, you changed income structures, you've acquired new debt, you've taken on a new account on your credit report. Then at that time, make sure that you are in touch with your lender throughout the home shopping and pre-approval process. So if anything changes, they can update that pre-approval amount. And if you have exceeded the 60 to 90 days, still haven't found a house, then renewing the pre-approval is very simple. It's just updating your pay stubs, your bank statements, things like that, and making sure that nothing's changed at the end of the day. Now, if you like this video, then you're gonna love the one that I did that goes over the steps after you've gone under contract and after you've gotten pre-approved.